Welcome to the 10th episode of Macro Pulse. We are 2 months into the year, and I think it's time for us to reassess market performance thus far. And from that, we'll be asking the question, did US exceptionalism peak? We'll also look at the South African budget that was postponed. But let's start with performance year to date. And the first thing that we will note is that performance this year is very different to what we saw last year. Last year, we had US equity markets outperforming. In particular, US tech stocks, the Magnificent Seven, performed more than 70% overall. And within that, it was driven largely by these tech stocks because the S&P 500, equally weighted, delivered about 13%. In South Africa, we also had decent performance, 13% overall, with general retailers, financials, banks, property, and even our bonds performing relatively well. Fast forward into this year, we've seen a very different setup. In the US, we see some underperformance relative to the likes of Europe and China. And within the US, the large tech stocks, consumer stocks, have underperformed, dragged down the index. In South Africa, we've seen resources, in particular gold, performed very well, also supported by Naspers and Prosus. But the question is, did US exceptionalism peak? And we think that this could potentially be a theme for 2025, where investors are becoming a little bit more concerned about the US. And there are several indicators, early indicators, that we can point to that support this. First of all, early part of this year, we had the DeepSeek R1 AI model from China that was produced at a much cheaper cost than its US counterpart. And this has really caught some of the US AI investors off guard. Secondly, we are seeing that US policy uncertainty are on the rise, and this is causing investor sentiment to fall. And thirdly, we are seeing some of the macro data starting to surprise to the downside. And remember, in the US, expectations for growth and valuations are fairly lofty. In terms of these macro data that's surprising to the downside, we've seen retail sales weakening, we've seen US consumer confidence falling, the US housing market data has been weakening, and also the PMI services, which is a large portion or represents a large portion of the US economy, has also now dropped to below 50, indicating that there's an expectation that activity in the services sectors may be falling. On the other hand, if you look at Europe and China, we are seeing some positive developments. And these positive developments is combined with the fact that valuations and expectations in these markets are much lower. Let's focus on Europe first. In Europe, in Germany, we saw the elections over the last week came out with a market-friendly outcome. In general, it's likely that the new Grand Coalition will be more market-friendly in terms of easing regulation, but also there's an expectation that they will use fiscal spending to improve on growth. We also see that there's a potential for a ceasefire now between Russia and Ukraine, and that may cause energy prices to come down in Europe, bringing down inflation, increasing real wages, and also increasing profits for German and European corporates overall. As inflation comes down, we'll see the ECB be in a better position to cut interest rates, further improving sentiment amongst investors. In China, on the other hand, we are seeing signs, early signs, that the property market may soon be bottoming and may be stabilizing potentially later this year. And Xi Jinping recently met with some tech leaders within the industry, and I think that is a key sign for the private sector and for technology stocks in China overall. So this all means that investors globally are reassessing their exposure to the US relative to China and Europe, and asking themselves whether they should be diversifying out of the US, where expectations and valuations are higher, to Europe and China, while valuations and expectations are lower. We believe that could be a key theme for 2025. South Africa has also been a fairly defensive play this year. Despite all the negative headlines over the last 3 to 4 weeks, we've actually seen the rand appreciating relative to the US dollar. And even after the postponement of the budget last week, we've seen asset markets actually holding up fairly well. Now, a couple of notes about the postponement of the budget. A positive signal from the budget that was going to be announced was that fiscal consolidation was still a key focus point. If you look at the details, there was still a focus to keep a positive primary budget surplus and to reduce the budget deficit over 3 years to about 3.2%. We also saw that the debt to GDP was going to peak in this year at 76.1%, so slightly higher than before, but still the focus to have that peak in this year. And so we think that the next budget that will be delivered on the 12th of March now will still contain a clear measure of fiscal consolidation. The other thing from this budget was that there was a clear intent to increase spending. So hiking the VAT rate by 2%, but then offsetting that by increasing spending in the economy. Now, overall, that is positive in the sense that we need infrastructure spending and we need spending on services to drive growth. However, we have to ask ourselves the question, are there some areas of wasteful spending where we could be paring back, where we should be paring back? And I think that is where the ANC and the DA is now focusing on to come up with a compromise. So ultimately, we think that the budget that will be delivered on the 12th of March may contain a smaller VAT hike, potentially also incorporate some spending, but also maybe providing some easing of regulation, business regulation in particular, that could drive growth. So it could be a very balanced budget, and we look forward to see what happens on the 12th of March. One last word of advice as we enter or are in this very volatile period of global policy uncertainty and political noise is that it's always important to play the macro and not the man. Keep focus on the macro trends and spend less time on the political sentiment and noise that we often see in the media. Thank you for watching. All the best.